Hello, everyone. Welcome to our yet another episode of our webinar. This is going to be talking more on our webinar on ESOP that we did a couple of weeks back. But this is going to be a little bit more detail based on some follow-up question that we got. My name is Shyam Sreenivasan. I'm the founder and CEO of Quantel AI and Quantel Asset Management. We are a SEC registered investment advisor based in New York City, in the heart of New York, Manhattan. And we help our clients, particularly the clients who are mass affluent or HNIs, to manage their wealth better. A lot of situations beyond the basic investing that everyone goes through. One of that is the tax planning. And we are talking about how to mitigate taxes in your ESOP holdings when you divest in ESOP. So a lot of details there we are going to cover in today's webinar. So hopefully this is going to be very interesting. So just looking at the audience here, we have folks from Salesforce, executives from Salesforce. We have execs from Google. We have people from Expedia. So a lot of these companies, Amazon, many of these companies, obviously are very generous in giving stock options. But if you're not managing it well, what goes up virtually could come down also, which could pose a huge amount of risk for the employees holding these stocks. So it's a careful management that we are going to talk about as to how you can manage it and maximize the opportunity that you get with your employee shares. With that, I'm going to introduce Jerry Yuan, who is our head of portfolio management at Quantel. Jerry has advanced degrees in quantitative finance and has been playing a role of portfolio construction and management for firms prior to he joining Quantel. So we manage retirement account as well as non-retirement accounts like joint account or trust accounts, etc., for our clients. And we use systematic portfolios driven by data and discipline. There's quite a lot of strategies that we deploy for our clients, and it's automatically managing for the risk that the market poses. As we talk about, there's quite a lot of market volatility there, and how we navigate the volatility to maximize the risk-adjusted return for the clients is what Jerry's team focuses on. And we can talk about those things, in a one-on-one call, probably after this one, if you're interested. Okay, with that, I'm going to get to the main topic of today's interest, ESOP, Employees Stock Ownership Plan, that a lot of employees get as part of their compensation package with various different companies. So with ESOP, the advantage is that there's quite a lot of wealth that grows over a period of time. If you have a career with a firm, if you have anywhere, say, between 5 to 15 years of career, you can actually multiply your wealth on the ESOP side of things if the company does well, of course, right? So the first question, Jerry, is many executives end up with a huge portion of their personal wealth tied to their company stock, right? The job is also tied to that company's performance. Obviously, the better the company does well, the better they move up in career. If not, if the company has any problems in transforming themselves to the changing market climate, etc., the company also goes down south, and their goals a job also, right? So there's a lot of risk there, and as well as the benefits, of course, is there. Why does this create such a unique financial risk that most investors don't face? They avoid this risk, or they're oblivious to the risk that's there with the ESOP that they're holding.
Yeah, so let me share the slide first. Yeah, so actually, you know what? I think because of in the past 5 years, a lot of tech company they are getting very good revenues, and so they're willing to give the employee a lot of employee stocks. And I saw a lot of our client, their majority of their net worth is from the employee stock. So what happened is almost some of them almost 70% to 80% of the total net worth is investing in the employee stocks. So that will what happen is that will make your net worth and your whole portfolio's performance heavily linked to your company.
Hmm.
Plus, you have the career risk, investment risk. If they're highly correlated, I think everybody maybe they don't feeling well with their company's reason. I know that after November, a lot of clients do keep asking us the question is why company stock price drop, right? Magnificent
Hmm.
Seven stocks, especially these Magnificent Seven, they drop a lot after last November. They are worried about that and trying to find a solution. I think the first thing come to your mind is you should be aware that your total net worth is heavily relied on one company.
Hmm.
It's very risky. Yeah.
Right. Okay, so clearly that risk is there. Maybe it's too late for someone to realize that the company has not done well, the stock has actually dropped, and then they diversify, right? They sell out. Maybe they don't have a tax loss situation at that point in time, but if somebody had been there in a company for 15 years, clearly the tax, the cost basis for that stock is going to be still a lot lower than the current price is of the stock. So while they have to face that the company stock hasn't performed well, let's take Amazon as an example, right? Last year and a half, the company stock hasn't done well at all, right? It's just been flat while the
Yeah.
market has gone up almost 20% since then.
Yeah.
So while you have to face that the company's stock hasn't done well, if you just impulsively sell that stock, there is a tax situation that comes up, which is like you have to pay 20% of the capital gains of your cost basis. Is that correct?
Yeah, I think there will be it's very panic I would say for this client is one thing is their company is not performing well and
Right.
they hope to move to other board diversification. Let's say maybe if, even the SP 500 is performing better than your company. It's possible, right? But they hesitate to sell these company stock. The main
Right.
reason is I would say 70% of our clients they worry about capital gains. If they sell these stock, they fear of triggering large tax bill, right? So what's the thing we provide is it's like a tax loss offset strategy.
Mhm.
So we can help them to handle that situation. Yeah.
Okay, so the second question, Jerry, is this. A lot of people know they should diversify, but emotionally, it's very hard to sell the company,
Yeah.
that built their wealth, right? If I work for a company and it's giving me a job, it's giving me shares at the end of the year, I get vested. I say, okay, if I'm just going to hold it, it's great. But how do you help clients overcome that hesitation of divesting from the company stock?
Yeah. So I think it's an open question. I mean, the first thing we need to know is your vesting plan, and also I know some company provide a purchase plan. For example, you can purchase your company stock at
Mm-hmm.
80% discount, right?
Mm-hmm.
So before we talk with you guys, I think we don't have this information, right? So after we know the cost basis and how much amount, for example, of your total net worth is from your employee stocks,
Mm-hmm.
we we don't have the answer. But for that, the basic idea is, I would say, taxes should be prioritized, right? If you want to sell the company stock for what? For emergency fund, you want to purchase a house, or you have other thing you need to spend money, right? And if you want to purchase house, definitely it's a huge amount of money you need to cash out from the employee stock. That will
Right.
be the biggest issue, right? The tax, you will spend a lot, huge amount of money to pay tax. Yeah,
Right. So there's obviously, if you sell a lot, you have to deal with the tax situation. No matter what, there's going to be a tax situation. We all want to pay taxes, but just right about, right? We are not trying to like evade taxes here. So one thing I want to tell the audience here is there is nothing illegal about what we are saying. It's about how to be smart in reducing your taxes in a legal way, right? And that's what we are talking about here. So clearly, if I have to buy a house and if you have to put down $100,000 of like upfront cost of the house, I have to liquidate somewhere. If I liquidate on the shares, and there's a 30% or 20% of the capital gains that I have to liquidate out, that's a significant chunk that goes out of my wallet, which I don't realize until the next April. In most cases, we don't realize of the tax situation until we run the numbers with our tax advisor and then say, oh, so much of money that I have to pay. So clearly, our goal is to reduce and be smart about it rather than trying to do anything, not legal about it. Okay,
Yeah.
so let's move on. When someone finally decides to sell their ESOP shares, taxes become a big concern. Can you talk about the strategies that exist to mitigate the taxes, not avoid taxes, but mitigate the tax? What can you do? Let's say this is a real example. We have a client with $500,000 of their company stock. Almost $400,000 is the capital gain. The company has done well, but unfortunately, the last 3 years, they haven't done anything at all. In fact, they've been going down. So here's a situation where either you stay put with the company with the hope that in the next 5 years they're going to be coming back to where they were. They have some existential questions right now with all the AI transformation. The company is not really seen as a company that's able to adapt to those transformation. We have seen many companies go down, like Blockbuster used to be a video company. Netflix came and Blockbuster is no longer there. So a lot of things happen that there is a churn that happens, right? So this particular company, the hope is that it doesn't go through that kind of churn. But $400,000 or $500,000 is capital gains, right? No matter what, you have to deal with the capital gain situation there. But what kind of strategies exist that you help the clients with if they come with their tax holdings, the different lots that they got?
Yeah, so I think that's two. We can break down into two parts. One is, this client, for example, they exit the employee stocks and they want to use money immediately.
Mm-hmm.
So they already realized the capital gain. But on the other side, maybe they have other investment in the individual account. So what we can do is use that part of money deploy into our tax loss harvesting strategy to generate these losses on another account. Um, so for example, if other clients, let's say they cash out the employee stocks, but they want to move to other strategy that's more diversified strategy, it will be the best case scenario. We can
Mm-hmm.
directly use the money to deploy to the, let's say, direct indexing or our flagship strategy. We will do the active management on these portfolios to harvest loss. So how it work is like, for example, let's say direct indexing, right? We have 500 stocks in per on yours, on your account.
Mm-hmm.
Every month, it's like there will be stock up, stock down, right?
Mm-hmm.
So these gains will be reserved on these gain stocks, but we will sell these loss stocks, harvest this loss, and move this position either to the similar stocks or other similar sector uh, sector exposures. So we keep doing that month by month. Ideally, by end of the year, the total account will be harvest around 10% to 20% losses by just doing that. So it's just like you have the realized capital gain, but based on our execution, we put them into these gain stocks again, and we harvest the loss on the other side, which is lose stock month by month on your direct indexing strategy on your account. Yeah,
So, couple of things I gathered from here is the time is of essence here. From a tax year point of view, the
yeah,
sooner you start harvesting the losses, the better it is because you give yourself enough time till December 31 to be able to do it, right? The later that you come for that tax year, if you sell something in October and you start tax loss harvesting, clearly you don't have enough time for that one.
yeah. And also, actually, you know what? If the market is very volatile, it's good for us. And
Mhm.
finally the market will always bounce back or be stable. Or let's say you want to tire with SP 500, right? You believe that SP 500 is always doing good in the past 20 years, 30 years, 60% of the year SP 500 is up and they have relatively low volatility. But we are doing direct indexing on those 500 stocks. So we still get the volatility from these single stocks. So it's like one slot of
Hmm.
each security, right?
Hmm.
It can be a tax harvest object. So
So the
we
goal is to
yeah
move from the single concentration to a certain extent. Of course,
yeah
analyzing the holdings that I have and then say which of these holdings has got the biggest of tax implications, moving that outside into a direct index kind
yeah
of holdings on the individual composition. And then as the market churn happens, you take out the stock which has got a significant amount of negative P&L on that.
yes
Hence, you can erase some of the gains that you have in your capital gains on your ESOP.
yeah. So instead of having ETF like SPY or IVV, right? The direct indexing will have the same return as the SP 500 ETF. But the good news is you can harvest loss at the individual stock level,
Right. So
right?
can you, Jerry, tell what is Quantel's unique offering, which you don't get from, let's say, a Betterment or a Wealthfront, because a lot of direct indexing product is there. Some brokers also offer that.
Yeah.
What is that versus this? I've heard a typical 3% of the portfolio value as what
Usually
is
it's
the
3%
effect
to
of a direct
5%.
indexer, but
Yeah.
you say 20% here in Quantel's offering. Can you explain that a little bit more?
So usually, for example, the Wall Fund also provide a tax loss harvesting strategy. What
Hmm.
they target is around 3% to 5%. So that's based on, for example, you just do one-time execution at the end of the year. Everybody
Hmm.
know that, right? For example, I have a 20 stock strategy on my 20 stock portfolio in my account, and
Hmm.
at the end, December 30th, okay, fine. Let's say five stock is negative gain, and okay, I just sell them and buy them back next month. After 1 month later, maybe during February time, I buy them back. So that's a one-time harvest they do,
Right.
and usually if it's on the direct indexing like SP 500, you do one time, it's around 3% to 5% annually. Sometimes extreme bad like 2022, you can harvest more, maybe 15% to 20%, but it's not consistent. So
Right.
what we are doing is we act more active manage that. We break down into small pieces, weekly to monthly. For example, past 2 week, the market is extremely volatile. So if our position drop, and let's say drop 5%, 10%, it's okay, right? It's a 500 stock portfolio, but some of these stock may drop 10%, 15%. We harvest this stock, move to the same peers or in that sector index, and 1 month later we buy them back. So we can trade more actively than just the year-end harvesting. So
Got it.
actually, we will be 3x to 4x more tax loss harvest than the year-end harvest strategy. Yeah,
So obviously, doing it once a year is not so great because you lose all that opportunity that comes up through the year. I've seen some examples, extreme of like everyday harvesting also, right? That's also not so great because you don't have enough negative P&L on your holdings to harvest. The only transaction cost increases, which is not so good for the portfolio as such.
yeah.
So
And
what you're
so the
saying is you
direct,
do weekly.
yeah, weekly, monthly, it's all based on the market condition. Yeah.
Right. So a day like today, where if the market is very down, clearly that's a great opportunity for us to do tax loss harvesting on that day.
Yeah, it's all based on our threshold systematic approach, right? We
Right.
have this threshold based on market condition, right? You
Right.
you don't want to see, let's say, if the markets keep going up, right? It's impossible to harvest the stock, find any stock have negative 15% drop in one
Right.
month. It's not possible.
Great.
So that the threshold is adjusted automatically, and plus, so this direct indexing is for this kind more believing these SP 500, right? For example, I just want to invest in SP 500. I don't want to try anything more aggressive. But we have our aggressive strategy can also do tax loss harvesting. So that's where 15% to 20% loss came from. So that's
Got it. So
not
instead of settling for an S&P return, you can also be more focused on, let's say,
some
AI theme as
systematic,
a
yeah,
strategy, and then
systematic,
do tax loss harvesting on that strategy.
yes.
Great. So you just mentioned, Jerry, that volatility is our friend here, right? For a tax loss harvesting, while we all see our portfolios go up and down during volatile condition like now, clearly from a tax loss harvest, it creates that kind of opportunity. When the waters are rough, then you actually can fish better, kind of a mode, right? So is that what you are talking about? Is like, how can market volatility actually create tax benefits for ESOP portfolios?
So I will say it's not like a market volatility, it's the individual stocks volatility. Because
Hmm.
when we do direct indexing, or let's say a strategy that have more than 50 stock to 100 stock, so let's assume maybe most of our audience here is very technical, right? It's just like a normal distribution, right? You will always find a lot stock that's a negative return
Hmm.
for 1 month or 2 months or even in 1 week, right? So these temporary declines create the losses,
Right.
and we harvest them and move to, let's say for example, let's assume Nvidia and AMD, they have the same performance, they have very high correlation a couple of years back, right? So just move from Nvidia to AMD, and 1 month later move back to Nvidia. You can harvest the loss, right?
Right, right. So, can you explain? I think some of the members here obviously would know what the wash sale rule is, but it's a little bit more detailed for maybe some of the folks here. Can you say that if I have a capital loss and if I sell, I cannot get tax loss calculated or utilized if I buy it back within 30 days. So can you explain that wash sale rule so that everyone understands?
So the wash sale rules is like, for example, you buy one stock A around $100, right?
Hmm.
And it dropped to $50. Let's say you have $50 loss,
Hmm.
but you feel like, okay, I want to buy it back. I
Hmm.
feel like this stock probably will bounce back again. You do, maybe you do too many trading. You are too overreact. You want to buy it
Hmm.
back. So
Hmm.
what happened is, if you buy it back in 30 days, right? The Let's say the stock price, you buy it back around $50 again and bounce back to 100. So what you will see is you have $50 gain. It cannot be used to offset the loss. So let's say if you just do two trade, you buy the stock A around $100, you sell it at 50, and you buy it back in 30 days around $50. It bounced back to $100.
Right.
What you will see is this gain loss was not offset.
Got it.
You
Got it.
only see the $50 capital gain. Right? That's weird, right? You have the same money at the end of the year, $100, exactly $100, but you need to pay tax for that
On the
$50
So
gain.
I've not really utilized or exploited the loss that was there in the books to my
Yeah.
advantage just by buying back. So one have to be very careful. One has to be very careful about these kind of tax situation that can be automatically triggered. One is at the point of sale, we got to be familiar with what are we selling. Okay, I have 500 shares of my company. I sell 100 shares. Which 100 shares you sell matters, because that specific lot may have a different kind of tax consequence compared to the overall holdings, right? So if I just say sell 100, the broker may have a certain rule, last in first out, first in first out, that kind of thing. So we don't know which one we are selling. We have to be really, really careful to not trigger these tax situation. But if we are not careful, at the end of the year, we get a statement from the broker saying that this is the total loss, and these are the loss that's not, utilizable for harvesting or the capital loss. On paper, you have loss, but actually, it's not loss from a tax point of view. So these are situations one should avoid, and that's where we can come and help, giving you that extra support that you need. So I've triggered a scheduler time poll here that you will have a link directly to schedule a time with us. So now let's go to the last question here. We are running out of time here, so just 3 more minutes. If a tech exec listening today has most of their wealth tied to company stock that hasn't performed well recently, what are the first practical steps that they have to take?
Yeah, I would say, yeah, maybe you should talk with us, right? We can make you feel more comfortable, right? What's the? I think we should learn from that. It's like, what should we do? Let's say 2 years ago, 3 years ago, right? And I have one friend join Snap a couple of years back around $60. At that time, their company stock price is around $60. Right now, it dropped to around five, right? As I would say, it's like, it's the 90% of the net worth, his net worth is gone.
Mm-hmm.
So it's very, very. I feel very sad for him also. So, um, I think, that come to the first question as well is how you need to make sure. First thing is your total net worth not heavily rely on one exposure, one single exposure, right?
Mm-hmm.
That can happen because right now the AI, AI things is very, it's very, very powerful, right? A lot of software company recently job are doing very, very bad, and also the Wall Street's giving their ticket price analyst rating lower and lower. So I still think this year will be very painful for these, software company employees.
Mm-hmm.
So, but I think that there should be some lessons. Is if you should not hesitate if you think, because you are working for the company, right? What's
Mm-hmm.
your view on what's do you think the company will keep growing, or in the near future will your company, come back again? Because you are more familiar with your business, what your company is doing, right? So sometimes you should not hesitate. We can
No,
schedule.
in many cases, Jerry, I used to work with a very large Wall
Yeah,
Street firm for 20 plus years, right?
yeah,
You working in a small silo of an ocean. The company is humongous. You don't know the full
yeah,
picture of like the company. You're working in a small group and you get excited because you're
yeah,
working on a project that's so interesting. But the
yeah.
big picture
It's,
of how
it's
the investors are saying is very different to what you see.
Yeah. So that's why I think I strongly recommend you talk with us and, start planning for it, right? How to reduce the exposure to the single stock, your employee stocks, and diversify it. Maybe to, SP 500, or you can try our flagship strategy.
Mm-hmm.
Or you want any advice? Let's say maybe you are cashing out your employee stock just for, buying a house. The purpose is to buy a house or for emergency fund, right? We should plan ahead. I will always say, not wait until the question you find the issue, right? You start to become active. You should, always think through it before it happens. So I strongly recommend, um, the audience, if you made the same issue, you can talk with us. And, for example, I can share one slide what we are doing for one of our kind, right? So we are setting a plan, a diversification plan for him. The good news is he invests in Microsoft. It's not dropped too much. So the existing plan will be 2 to 5 years. Gradually reduce your company exposure and move to SP 500 and, our strategy. So, and we do ongoing tax harvest because he worked for the company for a very long time, at around
Mm-hmm.
20 years, right? So,
Mm-hmm.
so the cost base is extremely low. But for these clients, if you already stock price already drop below the cost basis, I think, you should talk with us. We will customize the plan for you. Yeah,
Great. One thing that's clear is not to do things impulsively without knowing the tax consequences of selling a stock or buying back a stock, because that is not reversible, right? If you sold a stock, you cannot unsell the stock. Even if you buy back later, from a tax point of view, it is an event and it's triggered as an event. So you really, really have to be careful. There's no going back in those kind of decisions. So one thing I would urge the audience over here is to seek professional help. We are here to help you, and you can set up a time with us to discuss your specific situation, and then we can go from there in terms of whether you need help or not. Even maybe it could be a straightforward situation where you don't have as much, gain from a tax point of view, that you could just vest out, right? You if you've got it, the stock as vesting, but the total gain is not much. You can just exit out without really having too much of tax consequence, but have some professional to look at your tax lots, your vesting lots, and see what the tax implications are. Don't do anything impulsively because it's not reversible. So with that, I'm just going to open up the floor for any questions if anybody has. But if you don't have any questions, no problem at all. You can always reach out to us by email. You can reply back or schedule a specific call to discuss your holdings and whatnot. Okay, with that, thank you very much, Jerry, for a very informative session that we had on ESOP. Until next time, good night. Thank you. Bye.